Hey everyone, Dave Keller here with Market Misbehavior. I recorded a video back in November on this channel about Fibonacci retracements. We used a particular stock of Visa and talked about how to use those relationships to identify potential turning points in the price. We're going to update that for 2022 because so far in January you have a number of stocks in pullback mode approaching or breaking their key Fibonacci retracement levels. So today, it's why Fibonacci retracements matter in 2022. So Fibonacci retracements have been used by traders and investors for decades, and because the markets tend to move in fits and starts, or impulse waves and corrective waves, as Elliott wave aficionados would describe it. But there's no doubt that even if a market is in a particular long-term trend, there are going to be waves beneath the hood, right? There are going to be moves in the direction of the longer trend, and then shorter-term pullbacks within that trend. And the game for a lot of investors, a lot of traders, is identifying, timing those turns and identify when a stock is in just a brief pullback mode or when it might be something deeper and more destructive. Fibonacci retracements are a common way to do that because they set a framework for the price action and then help you identify some potentially key important levels using the Fibonacci framework. So we're going to talk about a couple examples here, starting with PayPal, and talk about how Fibonacci retracements can be used right now, given a lot of growth names and even some cyclical stocks like Goldman Sachs and other financial names are already pulling back. What levels might you expect support? Before we get to the charts, just a reminder, if you like this sort of thinking about investor decision-making, behavioral psychology, technical analysis, all the above, that's of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below the video. Do you agree with my assessment of these charts we're going to talk about? If not, tell me differently in the comments. Let's get to the charts. All right, so we're starting with the chart of PayPal, and really when you're using Fibonacci retracements, you only need the price action. All these other things like the moving averages, the RSI, the relative strength of PayPal versus the S&P. These are things I always have on my chart, so I'm just super used to seeing them that way. If I take all of those off, the chart would look a little naked to me, so I'll leave it as they are, but we're not really going to refer to those other indicators in this particular video, but other videos on the channel, I go through each of those in different ways, so I'd encourage you to check out some of our other videos. Now, the way you apply Fibonacci retracements is you need a stock that's essentially in a range, right? It's between two extremes. So for a lot of stocks in the US, you have a real clear set of extreme values. You have a low, most likely in March of 2020. Then you have a high somewhere in 2021, even maybe late 2021. For PayPal, if you know the history of this particular stock, from the bottom in 2020, we had a rally to a peak around just over 300 in February of 2021, retested that level in July of 2021. And from there, we've rotated back between those extremes. So this right here is a perfect opportunity to use Fibonacci retracements. And here's what you do. I'm showing on StockCharts how we actually do Fibonacci retracements. All platforms do some version of what I'm showing you. I selected Fibonacci retracements. I'm taking a low and I'm selecting the February 2020 low. And then I take the high here in 2021. And, I'm going to tighten up the levels a little bit. But if you look, right, if I start at the low in 2020, I go to the high in 2021, you can see why people tend to use Fibonacci retracements. Look how beautifully it found support at that first level. So here's when you apply these, right? When the market starts to come off. And the question is, where might we find support? You can immediately see the low from this 38.2% levels around 223. Turns out that's where the price actually ended up a couple weeks later, bounced right off of that level, tried to retest it here in late March, and then rotated higher. Spent the next 6 months or so chopping around those levels. What's interesting here is that support, based on the Fibonacci retracements, also lined up with previous price support. You can see we tested that same level around 223 in January a couple times. So at that point, seems like a pretty good opportunity to expect some price support. Now let's extend these and kind of go where they're at now. And you can see why these are still fairly relevant. So what happened afterwards? We retested the high in July of last year. We then rotated lower. And so the first level of support, according to the Fibonacci relationships, would be 38.2% of this distance, which is right at 223. That's the same level we talked about back here. So once again, we'd expect support there. It didn't happen. We actually gapped down below that level there in early November. From there, we broke through the 50% level, and now we've tested that a number of times from below. Now we're right at that 61.8% retracement level. As you can see, if you look to the left, you can see this lines up pretty well with lows that we had back in mid-2020. Lines up with the July 2020 low, also the September 2020 low. before we rotated to to hit 300 there in early 2021. So we have a number of indicators telling us that this particular price level around 170 is fairly significant. So what does that mean? What that means is you expect support there, meaning if you're looking for long-term an opportunity to add to a long position or to buy on short-term weakness, a lot of investors would use that Fibonacci level around 61.8% as an ideal time to build that position. In general, the way we tend to think of it as technical analysts is in terms of risk reward. You have risk down to this 170 level. You have plenty of upside potential if we would be able to regain our footing and push higher from there. But it also can be helpful in risk management. What happens if we get below 170 and break that final Fibonacci support level? Well, the Fibonacci analysis, actually Fibonacci retracement, would basically tell you that there's no real support left until down here, retracing 100% of the move from March 2020 to February 2021. So basically says, chart's constructive above 170, but if we break 169, we break that final Fibonacci level, there's no further support down to the previous lows. And overall, you'd have to look at some other indicators to try to identify some potential turning points. So PayPal is at a key level, and this 169 to 170 level could end up being incredibly important to identify if and when PayPal is going to find support here. Let's look at a couple other examples. Goldman Sachs and a lot of the financial stocks have actually started to pull back here. Again, taking the March 2020 low, going all the way to the November 2021 high, which is where we finally topped out. Now we're identifying some support levels between these two extremes. And if you look, you can see that the first Fibonacci level is all the way down here around 313 or so. That's not too far off of the March 2021 low. That was that first sort of downswing at the end of the first quarter before we rotated and pushed higher up into the 400. So what that basically means is now that we're selling off, that's your first downside objective. Now, what's different about the chart of Goldman Sachs that you didn't see on PayPal is we have a number of other support levels sort of pretty clearly identified. And I've highlighted these with these pink horizontal lines. We bounced off of this level here, which is around 370 or so in September and October. We retested that a number of times. We've now gapped below it, so that level is broken. We now traded down to another support level. This is the low from June and July, lining up very well with where we're at right now, which, what would tell me is this is a level of support you'd probably expect to hold. If this would break, though, you immediately go to that first Fibonacci level, the March lows, which is right around 315, we'll call it, a rounding error around those levels, 315 to 320. So this is to illustrate the fact that Fibonacci retracements, as far as I'm concerned, shouldn't be used in a vacuum. In reality, I'm looking at them along with traditional support and resistance levels, along with other indicators, which we won't be able to get into today, but thinking about how that all together paints a picture of what the price is doing. And what this does very helpfully is give you particular lines in the sand. As long as this specific level holds, the chart overall is constructive. If it gets below that level, then you really should think about cutting your losses or managing your risk and thinking about downside potential. There's a link in the description below to the previous video I did on Fibonacci retracements where we looked at Visa. Let's update what happened since we recorded that video. We recorded right about here in mid-November, which is right after Visa had bounced off of the 38.2% retracement of March 2020 to July 2021. Look how it bounced beautifully off of that level. Right after we recorded the video, it went lower for a couple of weeks down to the next Fibonacci support level, 50% from there, bounced up, and now we found support once again, bouncing off that 38.2% level around 206, 207. So what this means is overall, the price action is a lot more constructive as long as we remain above that 38.2% level. Remaining above there means there's further upside potential. I mean, there's certainly opportunity for the stock to continue to go higher, but that is how you define your risk. As long as we remain above that, the chart is constructive, we break that, and then you need to think about exiting positions or think about reassessing your risk and if you'd be comfortable riding this price potentially much lower. One final chart. Let's look at the S&P 500 using Fibonacci relationships. So we're looking at the last 1 year, and you can see some Fibonacci lines on here and a bunch of other stuff. And sorry, this is a very busy chart. This is my sort of normal S&P chart that I look at multiple times a day. I'm always adding levels and tweaking things. So it's a little busy, but if we just focus on these purple horizontal lines, these are the Fibonacci retracement levels. You can see they go back a little further than the chart. So we're going to add another 6 months of data, going back to September and October of 2020. This is kind of an important point, I guess. I'm often asked what Fibonacci levels, what price levels do you use to set the framework to pick the high and the low? And the answer is it's very subjective. What I tend to tell people is select significant highs and lows. So for me, the most recent major significant low was back in September and October of 2020. From there, it was in a fairly orderly uptrend going higher. That was the last multi-month corrective pattern that we've had. And from there, we've gone higher. So if I take that September low as the beginning, and I take the high from earlier in January as the peak, now we retrace 38.2% of that distance, and it's all the way down here to 4,200. So we've talked on this channel about levels like 4,700 as short-term support, 4,550 as key support, which we're testing again this week, and I would maintain that those are incredibly important. Below there, you have something like 4,300, which would be the low from September and October of last year. But the first Fibonacci level is actually all the way down here. And what it tells me is even though we've had a 6% pullback, which matches the deepest drawdown we had in 2021, a lot of the weakness we're seeing in growth charts here, if those would break down through support, that could absolutely be enough downside pressure, selling pressure to push the S&P well below where it's at, even down to that first Fibonacci support level at 4,200. So there you go. That's an update on Fibonacci retracements using 4 charts here in early 2022. We started with PayPal, which is maybe the most actionable because it's right at that first level. And that is when I would argue it's the sweet spot for Fibonacci analysis. That is when you see that there's been a big run, you see that there's been a pullback, and the question is, where does it find support? Fibonacci retracements can give you a really good sense of where potential support may be, where buyers may come in and add to positions and provide enough buying power to push the price back to the upside. We also talked about Goldman Sachs and what's happening with some of the financial names pulling back to key support levels. We updated the chart of Visa, which we shared earlier on this channel, and talked about an update to those levels, and the S&P with a longer-term level down at 4,200. What do you think? Do you agree with my assessment of some of these charts? If not, let me know in the comments below. Also, please subscribe to the channel if you enjoy it. We love sharing this content with you, and we'd appreciate that very much back. Give it a like if you found it valuable, and we appreciate that feedback as well. For Market Misbehavior, I'm Dave Keller. Stay safe. Talk to you again soon.